Hello everyone, I'm Tag
And this is Bob.
and you're listening to Bob and Tag Talk. Before we start the show, I'd like to point out that the topics discussed on Bob and Tag Talk are for informational purposes only. So please do not take this as investment advice. We urge you to do your own research before making any investment. So today we'll talk about growth stocks. What are growth stocks? What are a few of the growth stocks? And what happened to growth stocks recently? So what are growth stocks?
So, if you take any recent companies that have IPO'd in the stock market like Zomato, Nykaa, or Paytm, so generally they tend to be grouped as growth stocks because they don't earn any kind of profit or revenue at present.
Right.
So they are very forward looking, and then their aim is to grow the company to such a level that they increase their revenue, and they are willing to make temporary losses for a few years for the coming years or something. And their whole business concept is that in the next 10 years or the next 20 years, they will be such a large company, and then they will start generating a lot of revenues.
Okay. So, like you mentioned, Zomato, Nykaa, and all are a few of these growth stocks.
Yeah.
So, what are growth stocks that are now really established?
Google and Facebook are really one of the last 20 years they were growth stocks, and then they were really established.
Okay.
And even if you take like even Tesla is kind of a growth stock. They are probably established, but yeah, when they start out, they start as growth. Basically, they don't have profitability. They are not profitable. Their business is not profitable, but they are just forego profitability for now to make sure that in the next 10 after 10 years they gain a lot of profit. Like the main example is Facebook.
Right.
Facebook in the first 5 to 7 years they did not make any profits. They only made losses. But once they started issuing ads on the platform, they established the platform. They put all the when they start putting the ads and other kind of monetization on their platform, then they start making revenues. Then they become profitable.
And what do you mean by IPO exactly?
The initial public offer is when the company is first time listed in the stock market.
Okay. So they've gained enough traction to get listed on the stock market.
Any company can get listed in the stock market. There is nothing specific. All you need to do is like give your audited financial information and list with the board exchange of that particular country and say that you want to be listed, you want to borrow money from public investors.
Okay.
There are specific regulations that they have to follow. Then they can issue their shares at the public market.
Okay. So what did happen with the growth stocks recently?
So now the current scenario at in the economic situation is such that the bank interest rates are going to be raised.
Okay.
So all the growth stocks, their whole idea is that they borrow money, and they borrow money at cheap rates.
Okay.
Because the interest rates are cheap, because generally companies are getting loans at least in the US and UK at 1% per annum or 2% per annum at the maximum. So they borrow a lot of money from the banks. They invest in technology or infrastructure, setting up their company, and then they build these platforms or something like that, and then they try to scale their product and scale their services and things like that. Once that is done, and because of the cheap liquidity, that's what we mentioned in the market. So they're able to borrow, and then they'll have to spend a lot.
Right.
They're able to give deep discounts in their products, or they're able to give a lot of other services for free, and so on. And then they slowly popularize their brand and product.
Okay.
So once that brand and product gets established, then they will think about making profits and expanding their revenues and so on.
Okay. So now that the interest rates are increasing.
Yes. So the loans that they have taken up, the rates will increase. So their monthly EMIs or whatever the interest that they have to pay back to the bank will increase year on year as inflation increases and things like that. Interest rates will also increase, and eventually they have to pay back the bank. So they cannot continue to make losses.
Right.
So the business will really close down.
Yeah.
And the banks will start to demand their money back.
Yeah.
Generally, all these growth stock companies don't go to banks because banks won't give money to them. Generally, they go to these venture capitalists,
Private
investors. And then they'll raise money like Series A, Series B, Series C funding, and then raise the money. So eventually, the people who invest in these kind of companies, they will want their money back in at least 5 to 10 years. Or the whole thing is they will exit at the time of IPOs.
Okay. So, did it happen to certain stocks that they had to like close down because of this crash or something like that?
It happened in 1999, 2000. A lot of internet companies that recently got started at that time, they eventually everything got shut down. So eventually they closed their business, and most of the investors, most of the people who invested in IPOs ended up in losses in the 99 2000 bubble.
And now the growth stocks are like completely down, is it?
Yeah, so obviously the valuations are too high.
Right.
So basically, people have overpaid for the shares of these companies. So the only option is they can sell and take the loss, or they just keep it for 20 years and hope that the company makes profit and their business is sustainable and they get rewarded.
And in case the company decides to close down, which is like a worst case scenario, that's also
it's a loss.
Okay.
So we take the specific example of Paytm, and Paytm was IPO'd. It IPO'd at 2000 rupees, approximately 2000 rupees per share.
Okay.
But now it is down to around 780 rupees. So that's like 1,200 loss on one share for everyone who had invested in Paytm.
And that's in one day?
No, not exactly one day. It'd be in months, in the recent months. Let's say in the last 3 months or 4 months.
Okay.
So the whole point is there is no path forward for Paytm to be profitable in the next 2 or 3 years.
Okay.
So people really don't see that how Paytm can really make money or make profits. So they are very much pessimistic at least in the short term. So at least the Paytm as a company will be probably in the long term. They are still hopeful that they'll be able to make a lot of money. At least in the case of Zomato also, probably I think it got listed at around
last month,
80 rupees or something, and now it's down to like 50 rupees or 40 rupees per share. So all these companies like Policy Bazaar, and then a lot of other companies like MedPlus, and then Manyavar, which is Vedant Fashions, Star Health Insurance, they listed at really, really high prices. And when these interest rates start rising, or any kind of like war kind of a scenario, or when these kind of scenarios which will make the consumer think twice about buying something.
Right.
So that are the situations when really these companies will get re-evaluated.
Okay.
And then the market price will really go down suddenly.
Okay.
So this is one of the main risks of investing in IPOs.
Okay. So is it fair to say that you said that these sort of IPOs are usually overvalued, right?
Yeah.
So is it fair to say that during these sort of fluctuations, it comes down to its actual value?
No, you can never measure the actual value. You can measure the actual value only if they make a profit.
Okay.
Only if a business is profitable, you can actually evaluate the business properly.
Okay, understood. So you mentioned Zomato, Nykaa, Policy Bazaar, MedPlus and all. Is MedPlus the Manyavar one that you mentioned? Are they like recent? Are they upcoming ones, or are they already?
All of them have IPO'd recently.
Okay.
In the last 3 to 4 months.
So what are other upcoming IPOs that look promising, or
some of the other upcoming IPOs are like Delivery, which is the courier or package transportation logistics, and then Snapdeal, Oyo Hotels and travel.
Okay, yeah.
And then Boat Headphones, Fab India, MobiKwik are all some other new age company, new age startups. We have one large IPO that is still expected, very highly anticipated, is LIC.
LIC, okay.
Yeah, LIC is part of the government currently, and then it is really profitable. It does make a lot of profit. So this company, when it actually gets listed in the stock market, it will be at a really high price, but it will be profitable. It can be evaluated, but still people might pay a lot for the shares. But that doesn't matter, because if the company is profitable, at least you can say that 5 years or 10 years probably will get back your money, whatever you invested. Probably you can even make a profit.
But LIC is not a growth stock,
LIC
technically.
is a large company that will actually be profitable and it has large revenues. Generally, we cannot term it as a growth stock. Growth stock is like company is small, it is still growing. It will probably expand in market capital or expand in revenue.
Okay. And basically, growth stocks are ones that do not give dividends because,
Yes.
yeah, they don't.
Even now today, if you consider Google and Facebook, they generally don't give a lot of dividends. They have been growth stocks for a long time, and even probably they do have a lot of revenues now. They're established companies, they're large market cap companies, but generally they don't generally give a dividend. Worst case, they do a stock split.
Stock split, what is
Yeah.
that?
The price of a share, let's say it was listed at $10, or let's say it listed 10 rupees. Now eventually, after a few years, it became 200 rupees, and became 500 rupees, and you get 3000 rupees. So what instead of giving dividends, what the promoters would do is they will split the one stock into 10 or 1 into 5. So one share which was costing 3000 rupees, if we split into 10, then it will be 300 rupees per share.
Oh, okay.
So you'll get 10 shares. The person who owns one share, after a stock split will own 10 shares. It will split as 1:10.
Okay. Okay. Got it. Got
So
it.
that is the way of reducing the share price, increasing the shares in the quantity in the market. At the same time, it will encourage new investors to come in as well.
So, what other information do you have about growth stocks, and how do you think these stocks are gonna like revive themselves?
So the path forward for all these new age growth stocks we listed in the last 6 months is not very clear. At least Nykaa is a little bit stable.
Okay.
And then people are still at least preferring Nykaa over this Paytm and other things because Nykaa has a lot of sales.
Right.
So they are selling a lot of products and things like that. They can see that okay, this many product sales are still going on.
Right.
Even in the times of war or in the times of
Economic
difficulties, people are still buying products, so the business is still selling.
Right.
So maybe they'll look at the ratio called price to sales.
Okay.
So at least what is your share price and how many sales you're making per month or per year and so on. Then they can come up to some kind of an idea or evaluation.
Okay.
But things like Paytm and Zomato is difficult.
Okay.
So the sales is basically generally how many orders you fulfill and so on. So each business will have its own different kind of a metric. There's no defining metric to evaluate all the growth stocks.
So obviously Paytm they might have like put out a statement, or they might also be thinking about what they're going to do about the high interest rates, right? So they might have like some options or ideas about how they are going to move forward.
They will eventually have to onboard more subscribers, more users, and then eventually they'll have to start charging for some facilities.
Right, it's like some premium options or something like that.
Something like that, yeah.
And yeah, I think for a mostly payment service, it's sort of like difficult
They will
to
increase the transaction charges or something like that.
yeah, probably that's one thing.
Those kind of things they can look into.
What about Zomato? I think Zomato, the only thing is they get commissions out of all of the deliveries that they do, right?
Yeah.
So they'll probably have to increase all of that, which is
And they'll have to cut down their losses, cut down their discounts and things like that.
right.
And there are also other kind of growth stocks as well, which are profitable.
Okay.
So there's platform related companies like Tanla platforms. Tanla platforms, and then CAMS.
Okay.
And then there's also some IEX, Indian Energy Exchange.
Okay.
There are a lot of these companies like this, which are platform companies,
Okay.
which are considered to be growth stocks because they are also new. They don't make a lot of profit, but they are profitable.
Okay.
They just make the minimum profit of like 5 crores or 10 crores. That's it.
Okay. So what exactly do you mean by platform company?
Platform is basically they are enabling people to communicate with each other, share things with each other.
Okay.
The Indian Energy Exchange is an exchange where states or power producers can sell the energy to some other consumer.
Okay, understood.
So it's kind of a market or a platform. Generally, I can say it as a market.
Okay, so what other types of growth stocks can exist? We've seen these sort of growth stocks where it's like Zomato, Paytm, and all, and you've told me about the energy exchange. Ones.
And then Asian Paints is considered a growth stock.
Oh, okay.
Because as India grows, as more paint is consumed and so on, Asian Paints will continue to grow.
All right.
So basically, the business has to grow more than 15 to 20% year on year.
I see. Okay.
So if your revenues were 1000 crores, the next year it should be 1200 crores.
Okay.
So really, your revenue should continue to grow every year at least by 15 to 20%.
Understood.
So even companies like Asian Paints are facing a lot of issues today. So because of the war scenario in Europe, so the oil prices have really increased.
Right.
So the barrel price of oil has gone more than $120 or something. And then petrol prices, diesel prices will increase. And then Asian paints, generally paints are made from oil.
Right.
So their raw material costs are increasing. So at this point, the market perception is that Asian paints will struggle for some time. For 1 year or 2 years, they may struggle. Maybe they may not be able to pass on the prices to the consumers. And then even if all paint industry itself, if they increase their prices, maybe people will postpone their purchasing of paint, and maybe they'll postpone it when the oil prices goes low or something, prices decrease, then I will choose to paint.
That's very possible. Yeah, true.
Those kind of scenarios will decrease their profitability.
Okay.
So I think Asian Paints in the last 1 week or something has lost more than 10% of the share price.
Okay.
And the same thing with some companies like HDFC Life Insurance. And then any kind of company that is based on oil. So the raw materials are coming from oil-based industries. They're all getting corrected. The prices are going a large correction. And then any kind of consumer sentiment like luxury goods and products, like people will stop purchasing. Then because of high inflation, they will choose lower priced products, or they may postpone their purchases.
Right.
Then any company like footwear company or something like that, people will stop buying.
Right.
Then slowly their prices will people will anticipate that.
Right.
So the market is always forward looking.
Yes.
So in the next 1 year or 2 year, what is the scenario?
Right.
So today's price is a kind of an assessment of the next 1 or 2 year outlook. So the market, they always say it is forward looking. So that's why the market corrections will come really fast.
Right. Yeah, because people always want to,
protect their money.
Yeah, protect their interests and also be a little ahead in the game, sort of. Yeah.
They'll think ahead. Yeah. It's always about thinking ahead.
Got it. So we've seen a lot about growth stocks. We've seen about the crash, how they're going to survive it and all of that. So what is the anti-growth stocks say?
Any stable stocks like ITC, any consumer related like Hindustan Unilever. But even some of the Hindustan Unilever also stocks have crashed. But generally they do a lot of sales. There are some essential items that they will always continue to sell.
So why are these stocks considered stable?
The revenue, the money keeps coming in every month as and when people buy.
So this is also technically growth, but the growth is more stable.
Growth is a little bit, but the margins are very low. They are not really that profitable. For example, a watch, you can price a watch at 1,000 rupees, or you can price the same watch at 50,000 rupees.
Right.
So, but you cannot do the same with a biscuit. So the margin is really less.
Okay.
So people will buy 10 rupees biscuits, 20 rupees biscuit, they'll think twice about it. 100 rupees biscuit, they will never go for.
Yes.
So that kind of thing. The pricing power is not there with the company.
Okay.
So they have really less leeway to do those things. But there are a lot of other defensive, you generally call them as defensive stocks, like any banks. If you think of any banking related stocks, they're generally stable because financial. And then any kind of software companies are generally any profitable software companies like TCS, Infosys, large market cap companies, generally consider them stable. But this market has really cut down the price of HDFC Bank as well. HDFC Bank has lost more than 10% because all the HDFC group of companies have lost a lot of value in the stock market. So it's all about forward looking and things like that.
This just shows you how volatile the market actually is, and how just a tiny incident anywhere in the world can change.
So it's just a matter of weeks. The whole outlook can change. So
you mentioned a few of the international stocks that faced issues recently. What are some other ones, growth stocks, that have faced issues in the recent few weeks?
So some of the well-known stocks are PayPal, Robinhood. Robinhood was really popular in the last 2 years.
Okay.
So because of the GameStop mania and all that, a lot of people coming into the stock market buying their first shares. So Robinhood was the market outlook was really good. But now because of a lot of other scenarios, interest rates are getting increased. The US is really cautious about increasing interest rates. So when the outlook is not that good, so there's a large correction in the stock prices. Shopify, I think, has lost its value over 40% or 50%. And then Robinhood is more than 50%. and then 50% is like cut down in half.
Okay.
The price was 2,000, now it is 1,000.
Right.
So basically, you have lost 50% of the money that probably you invested in IPOs.
Yeah.
And then the company called Peloton,
Okay.
which was actually manufacturing this exercise cycles, which
we talked about it in the last episode. Yeah.
So then there are some new age companies, technology companies like DocuSign, and then Netflix and Zoom. Zoom was again very, very popular in the last 2 years.
Yeah.
Stock price was soaring. It was like $400, $500, and now it's just less than $100 or less than $150 something. So that's a huge loss for all the investors, growth stock investors mainly. And there are still some companies like Facebook. They also had large corrections, but their market outlook is not really good. Their what do you call it? The perception of Facebook is not good. And then Netflix, because it has to still spend a lot of money, and people might cut down on Netflix usage because of any things like that. So these kind of things also are all generally growth stocks, which are really in the international market. They're really at least 50% on average has been lost in value.
It's interesting how this interest rate thing is definitely one cause for all of these crashes, but it's also like what you said about the raw material shortage that's like affecting, and it's just a small thing that it sort of compounds, and the ripple effects like come into these
oil
growth
has
stocks.
A lot of ripple effects to multiple sectors. Oil in agricultural, oil in transport, automotive things, and then oil in like chemicals and petroleum related, paint related things. So oil has a lot of effect. So as in this scenario where oil prices are really rising faster and faster, so there will be a lot of correction in most of the stock market. The only sectors that are away from oil, so they may be a little bit stable. Like banking is completely away from oil. So maybe they may be stable. It's just a guess. Can never be sure.
Exactly. Yeah. All right. So we've talked about a good deal about growth stocks. We've talked a little bit about IPOs and what's happening in the current scenario. And I think that's a good spot to end it there today.
Thank you for listening to Bob and Tag Talk. Please consider following us on our Instagram and Facebook pages for weekly summaries and illustrations of the topics discussed on the podcast. If you found this episode informative, please like, share, and subscribe.